Okay, was that fun? Yeah, I think that was fun. So, the financial system. We need to talk about the financial system. So this picture of JP Morgan Chase, which is a huge part of our financial system, 270 Park Avenue. The original JP Morgan was on um, Wall Street, and Chase Manhattan was separate, and then they merged. The financial system in the United States is built on markets, right? Just like the rest of our economy, for the most part, is built on markets, our financial system is built on markets, and we think that's a good thing. If a bank is interested in its own existence and in making profits, then its operations will be governed by that, and it's going to try not to make loans that are going to go bad. It's going to try to understand what's going on with the company before it invests in that company. It's got an interest in making sure it doesn't do the wrong thing. When in Japan, when Nissan was in financial trouble, they had a bank that by the government's kind of decree and the way the system worked was tied to Nissan. And as Nissan went bankrupt, they basically took their bank with them. Nissan got fixed, sold to Renault, the government bailed everybody out and all that. But in the United States, we don't expect that to happen because we expect the bank, once the business is not doing the right thing, we expect the bank to say, wait, dudes, we're not going to keep giving you money if you're going to waste it. But in other systems, we've seen banks continue to give money because they're required to or they're culturally whatever, and we think our system's a better system. So there's a market for loanable funds. There's a market for loans at a bank, for people to put their money in and the bank to make loans, and we call that the loanable funds market. There's obviously, there's not a stock market. There's 40-something stock markets in the United States. There's lots and lots of stock markets in the United States. There's bond markets. Bonds are loans. We say that word bond, and sometimes people don't really understand what it means. If you buy a government bond, that means you're making a loan direct to the government. With no bank in between, nothing in between you and the government, you're just making a loan to the government. We expanded the Thomas O. Mack Center at UNLV by selling bonds. That means private persons gave money to UNLV. They loaned us money, and over time we're paying that money back. So instead of us going to a bank and the bank getting people to loan them, give them money, and then you're making a direct loan between an entity like the university or a company and the people who are actually making the loan with the money. Then there are lots of other markets for lots of other financial instruments. So we live in this world where the folks on Wall Street have created this plethora of different kinds of exotic and interesting financial instruments, and there's markets for these financial instruments, some of which we will talk about over the course of the semester, and then of course you'll go on hopefully and take more econ and more finance and talk about more of them fun things. What do banks do? Banks engage in something called financial intermediation. Do you like that? That's a fancy term. A bank is a financial intermediary, and it engages in financial intermediation. All that means is there's lots of people out there with a little bit of money, right? You might have, $500 in your savings account and a couple hundred in your checking account normally, and occasionally, you get a paycheck and you put that in, you get more money, but then you spend that down. But there's a little bit of money from you that's always in your bank. And there's lots of people who have a little bit of money that's always in their bank. Other people, or maybe the same people, they want to get a loan for a house or they want to get a loan for a car. So if you want to borrow $20,000 to buy a car, you don't have to hunt around to find somebody who's got $20,000. Your bank might have 100 people that have $200 each. It can combine the $100, the 100 people's 200 each, get $20,000 and loan that to you. So banks are able to bring together a little bit of money from a lot of people and then make loans, right? Financial intermediation is connecting the savers to the borrowers. So the savers put their money in, the borrowers take that money out, but the bank can put it together, combine it, make bigger loans than would happen otherwise. Okay, and financial intermediaries, it's not just banks, it's banks and credit unions and mutual funds and pension funds, all these different kinds of entities. Depending on what state you're in, Nevada has, in addition to banks and credit unions, it has something called thrift institutions. There's other kinds of things that may look like a bank that aren't. And again, later on in life, we'll talk about some of that stuff. What else does the financial system do? Well, it allows us to diversify our portfolio. The fact that there's a gazillion different stocks and a gazillion different kinds of bonds and all these different financial instruments and different banks means we can diversify our portfolio. We can share the risk. We don't have to put all our money in one place and pray it doesn't go bad. We can put our money in 100 different places, and if one of them goes bad, then we only lose 1%. Okay? Basic investment strategy is you should have a diversified portfolio. Our financial system's really good at allowing people to build diversified portfolios. It has a lot of options in it. Number two, the system provides liquidity. There's a lot of money in our system, and that money is flowing around through all these different financial intermediaries. That means that it's rare that people who have a good business opportunity or who want some money and they're good credit risks, it's rare for us not to find them. Liquid means kind of easy to spend. So liquidity means that there's available money in the system that people can get their hands on. The more involved and widespread the financial system is, the bigger the financial system, the more innovative the financial system is, the more liquidity there'll be in the financial system. And then the financial system is providing us with information, right? Businesses that are involved in the financial system have to provide information about that business so they can get a loan or sell a share of stock or do whatever. And that way that information gets shared across society. And we know a lot about businesses in the United States because they have to put their information out there because they want to participate in the financial system. Does that make sense? To be in the system, they have to put information out in public. And depending on what kind of company there are and other things, they may have to put more or less information. But if you want to go out in the stock market and sell stock, which most companies, big companies do, then you have to provide a lot of information to the general public so they can figure out whether or not they want to invest in your company. That information is useful not only to those investors, it's useful to a lot of people. It tells us what's going on in the economy, when that's not really its intent, but it tells us what's going on where we can see what's happening to profits and sales, and different parts of the country are being different. We can figure all that stuff out. Okay? Fun? Okay. Savings and investment. We need to do a little math. And I know that to many of you, algebra is a four-letter word. In fact, it's scarier to you than a lot of the more traditional four-letter words. But we can do this pretty simple and give you an idea here of something that's going on. Okay, so if you remember that GDP equals C plus I plus G plus NX, remember that? GDP equals consumption plus investment plus government spending plus net exports. Yes, we remember that? Okay, hopefully we do. If not, go back, watch the video, read the book again. We're going to get rid of the NX. We're going to dump the NX. We're going to have what's called a closed economy and just look at the United States in isolation without worrying about the rest of the world. Nothing fundamental changes here if we bring the rest of the world in, but it's just easier, to make our equation simpler. And if you remember from our discussion of that equation, we also figured out that GDP equals consumption plus savings plus taxes. We have these kind of opposite things that go together, and so you can figure out GDP by adding up C plus I plus G plus NX. You can also figure out GDP by adding up C plus S plus T. Okay? So we dump the NX, right? Poor NX, go away. And we can set the two things equal to each other. C plus I plus G equals C plus S plus T. Yes? Not CSI, CST. Okay? Do you notice that there's C's on both sides of this equation, right? Which means we can dump the C's and say I plus G equals S plus T. And you're like, okay, so, well, I can get the G on the over there with the T, right? I can subtract G from both sides. I can do a minus G. Like that. So I can say that I equals S plus T minus G. Are we excited by that? I equals S plus T minus G. What's that mean? Ooh, good question. How did I know I was going to ask that question? What does that mean? S is the savings that come from the private sector, that comes from the households. What's T minus G? That's the amount the government takes in taxes minus the amount that it spends. So if the government balances its budget, then T and G are equal, and that's 0. Okay? Everybody with me on that? Balanced budget, that would be 0. If the government takes in, $1 trillion and spends $900 billion and has $100 billion left over, that's like it's saving, right? If the government were to take in $1 trillion and only spend $900 billion of it, it would have $100 billion left over, which essentially is savings. So T minus G is the savings of the government. Now, we all know, and we'll talk about this more as the semester goes along too, that generally G is bigger than T. Okay? This year, if you're 2020 and you're listening to this, it's probably going to be like $3 trillion. That G is bigger than T. It's probably going to be the biggest trillions ever. In 2019, it was almost $1 trillion. That G was bigger than T. Okay? So if T minus G is a negative, that means that the public isn't the government, we call public, but that's public meaning the government. Public savings are actually negative. The government is sucking in savings from somewhere else to finance itself. Okay? So usually in our system, private savings is a positive and public savings is a negative. The only time since this that we've had a balanced budget, we had them, a little bit in the 50s, but the last time we had one was the last 3 years that Bill Clinton was president. Okay? So what's this equation mean? So I is going to equal total savings. And what I mean by that is, go back. I didn't rewrite that equation. I should have rewritten that equation. Look at this equation. Can we look at this equation here? S is private savings. T minus G is public savings. So I over here, investment, is equal to private savings plus public savings. Do we get that? So we come back over here. Investment is equal to total savings. And usually we just say I equals S and ignore the fact that there's private and public savings. The important thing to remember here is that there's this deal where I equals S in the end. Investment equals savings in the end. Now, we haven't gotten into real theory of how the economy works, and some economists are going to say, look, that's just an accounting thing. There's no magic in this I equals S. And then there's other economic theories that say, no, I equals S is magic. And yeah, that's part of the fun of macroeconomics, is that all macroeconomists don't agree on hardly anything. Okay, so remember back when we talked about, I know you're writing, stop. Remember back when we talked about the financial system, okay? And we said our financial system works through markets. Well, here's one. So this is the loanable funds market. On the y-axis, we have the real interest rate. We have an interest rate. And real means minus inflation, right? We take the minus inflation. Took out inflation. Across the bottom, we have the total amount of loanable funds. We have a supply of loanable funds, and we have a demand for loanable funds. So the supply of loanable funds is coming out of the financial system. That's how much money is available for people to borrow. The demand for loanable funds is the businesses. Okay? It's the businesses and the people who want to come borrow. So that supply of loanable funds, it comes from households, it comes from people and their interest, their desire to save, right? They create a loanable fund, they give the bank their funds, and that creates the loanable funds that are in the bank. Businesses and people then say, hey, I'm going to go borrow some money because I want to build a factory or I want to buy a house, right? People are going to come borrow the money. Because there's supply and demand, we know that there's going to be one magic interest rate called the equilibrium interest rate that sets the amount of money that people want to loan equal to the amount of money that people want to borrow. Let's look at that demand curve at the blue line. If you're going to go borrow money, do you like high interest rates or low interest rates? Well, hopefully you just said to yourself, low interest rates. If you're going to go buy a car, you want to wait until they offer, zero interest or, 0.9% or something. You want a nice, really low interest rate, and that's when you should go buy your car. Okay? On the other hand, if I'm a saver and the bank is trying to get me to save my money, it needs to offer me some return. There's hardly any reason to put your money in the bank right now because you're going to get, 0.25%. And we know from Dublin, right? Remember the magic rule of 70? If I take 70, divide by a quarter. If you're getting 0.25% in your savings account, it's going to take 280 years for your money to double. And probably you'll be dead. Unless you can get into an ice flow and, have somebody wake you up years from now, you're dead before your money doubles. Long dead before your money doubles. Your grandchildren are dead before your money doubles. Okay? So the supply of loanable funds slopes up because we need higher interest rates to encourage us to save. At least that's the theory in all this. And the demand is downward sloping because we want low interest rates to invest. So borrowers want low rates, savers want high rates. Somewhere in the middle, yes, Maren Morris, somewhere in the middle, we're going to find an equilibrium. Does that make sense?